Good morning, everyone. I am going to start very soon. If anybody can't hear or can't see the screen, please just feel free to pop a question in the chat box or in the Q&A. But everything should be working from your guys' side. We're going to start the presentation in a minute. And it's good to have everyone here. I assume there will be more people jumping onto the call as we go along, and that is fine. But just being cognizant of time, I think we are going to actually go ahead and begin. So a bit of housekeeping: your mics have been disabled, and you won't be able to speak or ask any questions during the webinar. But please feel free to email me any questions that you have, and I'll definitely get them answered afterwards. So the agenda for today will begin with Marise with the market and performance overview. And then she'll also delve into one or two shares in the Allan Gray portfolios as an idea of good investments going forward and the value that Allan Gray sees in one or two of these shares in their portfolio to grow wealth into the future. And after that, we'll have Taryn Duncan, who will then talk a bit about some behavioral aspects to financial planning or to investment management and your finances. And then I'll close off after that. But yeah, it's now 32 minutes past 11. And with that, I'm actually going to pass over to Marise to begin the first bit of the February 2021 investment update with Villic Wealth and Allan Gray. Thank you very much. Marise, please go ahead.
Hey, can you all see my slides? All good?
Yes, perfect.
Awesome. So hi everyone, my name is Marise and I joined Allan Gray 10 years ago as a client service consultant for 3 years. And then I fulfilled the role of a business development manager where I assisted advisors with building their practices, similar to what Taryn is doing. My colleague is also on the call. And my current role is a Manco specialist in the retail distribution team. So you might wonder what that means. So Manco basically is the management company which allows investors to pool money together for fund managers to invest. And in this case, Allan Gray is the Manco for Allan Gray funds. And I assist our internal consultants and advisors with understanding of funds and performance. So just from my side, quick introduction, and thank you for the opportunity to share our views and thoughts with you. And as you all can possibly testify, I mean, the last year taught us many lessons and just drove home the fact that it's impossible to predict the future. And while the uncertainty caused by COVID-19 still persists, I mean, the recovery of financial markets over the past few months really just brings fresh hope for us as investors. So let's start off with looking what has been happening in the market. So just the two agenda points that James also mentioned. I will start off with a brief market overview, which will then be followed by a discussion on how movements and uncertainty in the market relates to our performance and positioning. Okay, so let's have a look at our local market. This is the FTSE JSE All Share Index price level. So it's also known as the ALSI. And what I want you to focus on is on the short term. So if you look at that red line with the arrow, we can see that the recent uptick in the market price level compared to the lows of March last year has been quite significant. So we can also see that in January, things moved quite quickly. So maybe just 3 points that this graph is telling us. Number one, things can change very quickly. I don't think anybody would have thought that the annual return would be 15% at the end of January. I mean, given the drawdown in March last year. But the stock market is already looking forward to recovery, even despite a much stronger second wave in most countries. The second point that I want to make here is that news of the vaccine and a Biden win towards the end of last year has supported sentiment towards emerging markets like ourselves, which contributed to the Aussies return ending the year in positive territory after, like you all know, declining 35% in March. So even though emerging markets will face severe public health challenges, it is likely that the economies will be supported by strong exports to some of the developed countries. Then the third point that I want to make here is that over a long term, the recent performance has definitely helped in pulling up the 3 and 5 year numbers, but it still remains muted compared to history. And we will look at those performance numbers in a short while. So let's have a look at one of the drivers of our local market. And what we are seeing here on this graph is definitely a surge in commodity prices. Now, commodities, they involve gold, platinum, iron ore, etc. So some even call it a commodity boom that we're finding ourselves in. And this commodity boom dramatically changed our fortunes. So the graph shows you the dollar value of our top exports, which have increased massively. So mining produced record revenues and profits in the last 6 months of 2020. I mean, our revenue from the 10 biggest commodities we exported grew by $1 billion per month. That is 3.6% of GDP. One thing that I just do have to mention is that it's more the price of commodities than the volume that has increased. So the very strong growth in China has kept the metals market going, and there has been supply shortages, definitely. However, China is trying to orientate itself away from commodities. So China has this 5-year plan where they're trying to avoid the old formula of just building things, and they want to use this new strategy. So this might result in lower commodity consumption and also maybe, lower investment, definitely a different economy to what we are used to when it comes to China. But the issue with that is while we are seeing a current commodity boom, it could go into the next year, but it's not like it was in the first decade of the century where you had a commodity boom that went on for 9 years. So this one is going to be a couple of years at best, but it still remains important for us. And then on this graph, we can see the major turnaround in our balance of trade. So maybe just what is the trade balance? That is the difference between the exports and imports of goods and services. And our trade surplus is now the biggest surplus we had in many years. And this is also a reason why the rand is relatively strong at the moment. Then we also have a current account surplus. This number is almost equal to the number during the gold boom of the 1980s, as you can see on the graph. And I mean, this is a totally new situation for us. You have a very strong trade surplus as well as a strong current account. And I mean, the current account records South Africans' transactions with the rest of the world, and it's basically an indication of whether more money flowed into the country than out. So a sustained current account surplus is good news for the rand, inflation as well as for interest rates. So maybe as I'm touching on the rand in South Africa is our shock absorber for our economy. So we saw, a sell-off during the first part of last year, but the rand has actually been coming back, which surprised a lot of people. But there's a good reason for this, maybe 2 reasons that I can just quickly mention. One is the current account has massively improved, as we can see from this graph. And then second, capital flows are starting to come into our country. So when the Americans print money crazily, the money will flow out of America to the rest of the world, and definitely some will come to South Africa. So if the current account surplus continues, and if there's greater confidence regarding our fiscal situation, it's quite possible that you will see the rand becoming even stronger, maybe even nearing close to 13 rand to the dollar. Our economist, Sandy, actually said he doesn't think we've seen the end of the strong rand just yet. And one positive thing about it is that it will keep inflation low. So the Reserve Bank will remain a hold on interest rates for now, as long as inflation is low. And it's even possible, if the budget is well received tomorrow, that we could see a further smaller cut. So the rand is definitely on a strong tandem at the moment. And then this is the same graph that I showed you in the beginning, I now just want you to focus on the long-term trend here. So if you look at that horizontal red line. So this graph highlights something very interesting. So even if you had a 20-year career managing money in South Africa, you would have never seen anything like we have for the last 6 years, where the market has just gone sideways. So after the 2002 correction, the market was back where it was after a couple of years. After the global financial crisis in 2009, it was, also very short-lived. You were straight back to where you were within 2 to 3 years. So we never really had a period where for a long time the market has basically just gone sideways. So the question is, what caused it? So has had a tough time. I'm sure all of you are aware of that as well. Economic growth has been low. It's been a really tough environment. And 5 years ago, valuations were elevated. And I can remember when I was, at Allan Gray in my previous role, I remember our portfolio managers also warning clients to say that valuations are really high 2015, 2016. So the end result is that has corrected. And today we think that valuations are probably below normal. So while the South African market is below normal, we are quite optimistic, in terms of absolute returns. So maybe just to put it differently, we don't know when, but over the next 5 years, we think there's a good chance that returns from the South African market will be higher. And on top of that, we are also excited about the opportunities to add that extra alpha. So it's going to be very interesting because at some stage, we are going to have a bull market again in South African equities. And it's actually going to be very hard for fund managers who lived through this sideways period now for 6 years. And as you also know, a bull market starts from quite a lot of pessimism. So it's hard to think now that the South African market will go up in a few years, given all the bad news that we're experiencing. But that is how a bull market starts. And January has definitely changed the picture quite a bit, but we'll have to wait and see what's in store. And then let's just have a more zoomed in view of South African shares. So South African shares are very often the largest component of balanced funds. And we know that South African market returns have been disappointing. And that also explains the underperformance of some balanced funds and definitely our own balanced fund as well. So the disparity has been built up. The disparity that has been built up in the market definitely still remains. So what we're doing here is we're slicing the returns for the Aussie into its different components. So what I've done on this slide is just to take a look at last year. So basically 2020 in review. Last year, the return from the market was 7% for the Aussie. And I've sliced the Aussie returns into 4 buckets. And each of these is the contribution to the total index return. So if we look at the first one, Naspers and Process, that's a 7% contribution. So Naspers was up more than 7% last year, but its contribution to the total index was 7%. And that basically accounted for all the return. And then the other buckets, which also did well, would be the big diversified miners like Anglo American and BHP. And those are big components of the index. So they contributed 5%. And then the precious metals, your gold and platinum, added another 3%. And then all the other shares on the JSE, so everything that's left, all the industrials and the financials and so on, detracted a total of 9%. So if you add up all of that, it gets you to 7% for the Aussie. So that last bucket is actually really the interesting one right now. I mean, most shares were down last year if we look at that last bucket. And if we do the same exercise for the last 4 years, the picture looks almost identical. Last 4 years, those first buckets did well. So Naspers, the diversified miners, precious metals, they did well over a 4-year period as well. But really the average company on the JSE has had a poor showing over 4 years. And in the average case, the share price is lower than where it was 4 years ago. So it's really quite disappointing, but that would also suggest that there probably should be opportunities for ourselves like active managers, and that is definitely what we are finding at the moment. So we think there's a lot of opportunity for this disparity that we're seeing in the market to close. And although you definitely shouldn't just go out and buy all these companies purely because they've underperformed for 4 years, Of course, you want to be selective, and that is exactly what we're doing. I also just need to mention that last year in the fourth quarter, we did see a much more broad-based recovery. So some of that rest bucket also recovered a little bit, but our market still remains quite concentrated. And then if we take a bit of a longer term view and we just think, what has your return been like from equities as a South African investor? And we know that if we look at different countries across the world and we look at very long-term periods, say 50 to 100 years in most countries, equities typically give you a return in real terms after inflation of something like 5 to 6%. So 5 to 6% above inflation. That's kind of the very long-term numbers. But within that, obviously, you have big ranges. And typically, you would expect to do better than inflation, at least when you invest in equities, because you are taking on extra risk and volatility. But what you can see on this slide is the red line. So that's the equity return, and I've just smoothed it over 5 years. And it gives you the return from South African shares over cash. So if the number is above zero, you're doing better than cash over 5 years. And if it's below zero, you're doing worse than cash. And the thing you would immediately notice is the last 5 years' returns have been worse than cash on a 5-year rolling basis for the all share index for our market. So returns have been disappointing, and you would have been better off actually being in cash in hindsight. And we can go back a few decades, even further back than this chart, and there have been times where this has happened in the past as well. So we always say, you should be investing for the long run, and the short run is volatile. But I think for most people, 5 years is a fairly long-term period. So to have 5 years where you do worse than cash or worse than inflation is quite disappointing. But like you can see, it does happen at times, and there have been previous cases in the past as well. So often in these cases, as we've seen in the past, people get quite negative. They don't want to be in shares anymore. They'd rather be in cash and bonds. And they quite often, the subsequent returns for the market do end up being quite attractive because valuations are now a lot lower than before. So we find that often people miss out on these good performance after a period of underperformance. So we think that might be true today as well. So there's no rule that it has to recover, but there certainly are indications that valuations are below normal. And given that returns are very low, we think returns from here could actually be quite a bit higher. But once again, there's not really certainty on that timing. And then another way to look at the returns we've had over the last decade is to look at the JSE versus the world index. And what I've shown on this slide is a relative chart. So when the line is going up, it means that the JSE is outperforming the world index, as we can see here. And when the line is coming down, it means the JSE is underperforming the world index. And when the line is coming down, it means, often people forget that South Africa outperformed world markets for 8 to 9 years in the previous decade. And it's just remarkable how straight that line has been over the last 10 years. And again, it's quite, a disappointing picture for South African investors because the JSE massively underperformed versus the world index. And this is despite many of all these large multinational stocks like Naspers, doing quite well over the last period. So you can say that, of course, South Africa, scored a lot of own goals. So we've made a lot of policy mistakes and all those kind of things. And I mean, that's definitely true. That's part of the picture. But part of the reason is also emerging markets in general have underperformed the world index. And the US has done really well. And in most emerging markets, we actually have a similar picture to the South African story of underperformance versus the world index. And then just one small thing to mention here is what's very interesting. You can see that red arrow just appeared, is that over the last 4 months, the South African index started to outperform the world index. And I mean, we've had false starts over the years. In 2013, we've had a false start with Ramaphosa in 2018, but we'll just have to wait and see what's in store. And then the last kind of angle or lens to look at the JSE returns is to look at returns in dollars. So if we look at the last decade for the JSE, represented by the black line at the bottom, this is now in dollars, you'll see the line is pretty much flat. This includes dividends as well over a 10-year period in dollars. So if you think about you could invest anywhere in the world, this is quite disappointing. We've pretty much gone nowhere for 10 years. And that's, like I said before, despite having some big winners like Nasdaq. But you can contrast that with the experience in the US. So if you'd invest in the US, the S&P, the red line over 10 years, you'd be up about 3.5 times. So obviously it's been phenomenal, a bull market in the US, and it's not been the kind of normal historical performance for the US, but it has been way beyond that. So certainly a huge difference in quantum in terms of how much the JSE has underperformed the S&P. But it's very easy to look at this kind of picture and almost form a narrative of why this is so obvious, or why it should have been obvious, or why it will continue to be obvious in the future. I mean, you could say things like US companies have better management, they make higher returns on capital, they operate in more stable business environment, they've got access to bigger markets, more educated people. So you can form all these kind of narratives, and some of these things may be true. And in hindsight, you might form these arguments and say, surely we should be investing in the US market as well, because returns have been so much better and these companies have all these advantages. But I think it's a very dangerous way of arguing, and it kind of ignores the historical perspective. So we can also look at the full history, which is maybe useful just to compare another decade. So now we rewind 10 years. So going back one decade, looking at the period from 2000 to 2010, you'll see the picture is the exact opposite. So during those 10 years, the S&P, the red line, was flat for 10 years, which is quite remarkable actually. So we know the US had a poor period during those 10 years, but it's also quite interesting to compare the numbers and just see how big the quantum is in difference. And again, this is also including dividends, but there's many reasons for this. So part of it is starting valuations were very high in 2000 and the ending valuations in 2000 were quite low for the US. So those are definitely contributing factors, but all the factors I mentioned earlier, like good management, high return on capital, stable business environment, all those things were true back then as well. So, and it didn't mean you couldn't get poor returns. So because valuations were so high when you started out, that was actually the determinant, the actual valuations. But in contrast, when you look at the JSE over that period, it's almost hard to believe how good the returns were in dollars. I mean, we had a 10-year period where the JSE went up 6 times in dollars. And why was that? Valuations were low at the start and they were higher towards the end. Expectations were definitely really low at the start. Growth was better than what people expected. So we had a commodity bull market, which really helped. Foreigners back then also didn't own a lot of South African shares at start, which is maybe to some extent true today as well. So it's just interesting how different the outcomes were. So I'm not necessarily forecasting that the next decade is going to look like this picture, but I think it's definitely dangerous to conclude from the recent performance that the JSE will always be a worse market than the US, for example, which is something that's obviously tempting to do, just given the human nature of focusing on the recent past, which is the recency bias. And I'm sure Taryn is going to touch on that later. And then I've talked a lot about the South African market and how we think valuations are below normal, and we're quite optimistic in terms of absolute returns from here going forward. And we don't know when they will come, but over the next 5 years, there's a very good chance that returns are going to be higher from the South African market. But I don't want to give you the impression that we are massive bulls on South Africa and we're just piling into South African companies, because of course there are a lot of risks that we need to consider, and we're definitely aligned to those risks. If we just look at our fiscal deficit on this graph, it's something like 15% of GDP. And the next few years, we are still going to face substantial deficits. So if you think of it simplistically, how do we solve the deficit? Either we need to raise taxes or we need to reduce spending. And those are kind of the two major levers you can pull as a government. And both those levers reduce earnings for companies. So either you need to tax companies and the spending individuals in the country more, or you spend less money in the economy, which is also bad for company earnings. So we also need to ask, what does it mean for foreign investing in South Africa? If foreigners deem South Africa to be too risky, there's a good chance they might disinvest from South African companies, which could cause prices to fall. So those are definitely headwinds, and those are things we need to consider when we are investing in shares and bonds. And maybe the more relevant thing in the balance fund is probably to think about, what about bonds? So I just have one slide here to speak about bonds. And on this graph, we have the 10-year government bond yield. So South African bond yields are quite high versus history, as you can see from this graph. And we've got all these risks on the fiscal side. We also have a growth challenge. So there's definitely lots of risks to consider. Within our balance fund, we have about 10% invested in bonds. But we think, even given the risks, these yields are quite attractive and they sufficiently compensate an investor for the risks being taken. That being said, we are probably underweight many of our peers on government bonds. But we have been increasing the position, and it's probably the biggest asset allocation move we've made last year. And we've used some of our cash position to buy some government bonds. So I guess one of the big benefits in the balance fund is also being a very diversified fund and having the flexibility to move between asset classes so that you can take advantage of these kind of opportunities when they arise. Okay, then let's have a look at the performance and the positioning of our Allan Gray balance fund as an example. So here we have a look at Allan Gray balance fund for the last few years, the performance of the balance fund versus the benchmark. And as you can see over the last year, I think there's maybe two important things that we should note. So firstly, from a relative basis, the Allan Gray balance fund lagged its benchmark over the last year, and also over 5 years, we are kind of in line with the benchmark. And it goes without saying, we are trying to do better than that, and it's not what we are aiming for. And I've already mentioned the broader drivers in the market, but I will also discuss some of the fund-specific drivers just now. So this is the relative performance, but I think the most important thing for a lot of investors is actually the absolute performance. And that's been the striking feature of the last few years. So if we just look at the last 5 years, if you've been invested in the balance fund or any other balance fund really, you've gotten a return that's kind of in line with inflation or maybe just ahead of inflation, which is quite disappointing. So you've been invested in shares, you've taken on this volatility of returns, and you haven't really seen the fruits of that. And maybe in hindsight, you should have been in cash, a lot of people would say. So absolute returns have definitely been disappointing in the South African environment. So maybe just to focus specifically on our balance fund, let's have a look at which shares contributed or detracted from performance relative to the ALSI. So on the left, we have the contributors, and on the right, we've got the detractors. And the U, if you see there's a U next to that specific share, it stands for being overweight, having an overweight position relative to the ALSI. And the O means for overweight relative, the U is for underweight, and the O is for overweight relative to the ALSI. And what contributed on the left-hand side, being underweight pretty much anything that was considered a South African income share, like FirstRand, Sanlam. It's not showing here, but definitely some property companies as well. And then on the right, as a detractor, what has been detracting is being underweight some of the large counters, your mining companies like BHP and Anglos, and definitely also Richmond, which is a luxury company, and that has really done well over the last year. So we were also overweight the wrong resources. We had quite a big exposure in Sasol and Glencore as well. And maybe just to give you an example, so if we look at British American Tobacco, which has been a detractor here, the fact that we're overweight, and Richmond, I just want to sketch this scenario. If someone tipped you off a year ago that British American Tobacco would grow its earnings by double digits despite the pandemic, that they will take significant market share in premium tobacco and reduce risk products such as vaping, that they will pay down their debt on top of a generous dividend. One would have thought the sentiment would improve for that share. But it turns out that sentiment actually deteriorated in 2020, with the multiple that was on 10 moving down to 8 now. Looking at Richmond and contrasting it to Richmond, they started 2020 on a very high multiple. You were paying 28 times for earnings back then, and it suffered a significant reduction in earnings, but it still managed to outperform the stock market by 15% for the year. So even if you predicted the short-term fundamentals, you would have made the wrong conclusion since sentiment surprised. So, that is just one of the things that was quite surprising for us, but we invest for the long term, and we are sure that there's still a lot of upside to actually to come through British American Tobacco. And then also I read this morning that Sasol said yesterday that they've decided not to pursue a rights issue of up to $2 billion after they've made significant progress in their turnaround strategy. So Sasol CEO said they aim to announce further asset sales, towards later on in the year and next year.
So Marise, can I jump in there quickly?
Yeah.
Just for me, what is interesting, if we just look at British American Tobacco, and you'll inform this a bit more, but we were all up in arms when it made no sense during lockdown for the sale of cigarettes and so on to be banned. And the market would look at a business like British American Tobacco and say, well, how are they supposed to make money if you're not allowed to sell cigarettes in South Africa? But my understanding, and please inform this a bit more, British American Tobacco is like the second biggest global player in tobacco. Yes. And South Africa was one of the only countries in the world during the pandemic that had actually restricted the sale of tobacco. Yes. Yes. And then also the revenue that BAT, British American Tobacco, makes from South Africa isn't big compared to its total revenue base. Could you talk to those few issues?
Yes. So I think it's something as low as 3%, the revenue that British American Tobacco is actually making from South Africa. So it's a very small player, South Africa, if you look at the total earnings profile. And also, when we think about cigarettes, yes, the numbers have come down, but when you think about the cigarette economics, or basically tobacco economics, they call it, they have managed to actually increase their prices, although demand has been coming down for quite a few years. So that's really been a plus for British American Tobacco. And yeah, our investment case still stands. And sometimes we forget that South Africa is a very small part compared to the rest of the world. Our market capitalization is like 1% compared to the rest of the world. So British American Tobacco is definitely a global player, and the fact that restrictions on our cigarettes had almost no effect on them.
Thank you. Please carry on.
Cool. Okay. Then how are we positioned in the balance fund, and what is our outlook going forward? So diversification is definitely a big benefit, and it's maybe just useful looking at the different asset classes that build the whole pie, which represents the balance fund. So I've talked a bit about South African shares and how we think the market is attractive, and we think valuations, are reasonably attractive. But that being said, a big chunk of the balance fund is of course invested offshore. So if you just look at the dark red area, about 30% is invested directly offshore, which is managed by our sister company, Orbis. And I'll talk about the offshore bit just, in a few minutes. And then you've got small slices in rest of Africa and precious metals. Those precious metals would be platinum and gold ETFs primarily. But the biggest chunk of the balance fund is invested in South African shares. About half of the portfolio, you can see these two, is invested in South African listed companies. And I think the important thing to note here is we all know that a lot of South African listed companies are not really South African businesses. So of that 50% in South African shares, about half you could probably call domestic businesses. We call them SA Incs sometimes, SA income companies, and about half foreign businesses. So the foreign businesses are things like Naspers, British American Tobacco, Richmond, companies that don't generate really a meaningful amount of their earnings in South Africa. So when you're buying those assets, your underlying risk is not really South Africa, even though the assets are listed here. And then half of that would be our domestic companies. And in the last slice, that would be property. And then also we've got South African bonds and cash, which I already spoke about. So
if can I jump in again, Marise?
Yes.
So basically, what we're saying is that essentially 2/3 of the balance fund is essentially offshore, because Africa is non-South Africa, and that would be businesses that don't that aren't tied to what happens in the South African economy. You've got precious metals, that's maybe South African related and South African economy related. But offshore SA shares, I would hazard that we're looking at 2/3 of the balance fund that is actually positioned offshore, and that has a much smaller effect, or the South African economy has a much smaller effect on 2/3 of the balance fund.
Yes. And it's probably closer to what you want in your overall portfolio, to diversify your risk. Because as I just mentioned, South Africa is only 1% of the market cap out there. And also just to mention, we are almost close to 70% net equity weighting in our Allan Gray Balance Fund. It's the highest net equity weighting for well over 10 years. So that is just quite interesting. And I mean, 2 reasons for that. We bought a lot of shares in March and April. And also second to that, all those shares have gone up a lot. Okay, then I talked a bit about the foreign versus the local components in the balance fund, and what you're actually getting when you're buying the balance fund. Like James was saying, 2/3, be having offshore exposure. And I think this is probably a good reflection of that. So if we look at the biggest South African listed shares in the balance fund, we have some domestic businesses, which we are very excited about. Something like Woolworths, you'd see creeping up in the top 10. It's a local business that we think is very attractively valued and has good prospects. But then the biggest companies in the balance fund are actually non-South African businesses. So if you look at the 3 biggest holdings, Naspers, British American Tobacco, Glencore, these are really non-South African businesses, and they make most of their earnings outside of South Africa. Then maybe just to touch on Woolworths. So Woolworths share price peaked at over 100 Rand in 2015. You can see the peak over there on the back of strong trading performance in South Africa and the acquisition of Australian department store, David Jones, for over 20 billion Rand back then. And they had the aim of creating this Southern Hemisphere retail giant. And the market was willing to pay, more than 25 times for Woolworths earnings at that time. But since the peak, Woolworths has underperformed the Aussie by over 60%, as the market realized Woolworths had significantly overpaid for David Jones. And also, the South African economy performed poorly, and the clothing division produced mixed results as well. So this change in sentiment offered an attractive opportunity for us to build up a position in the portfolio as the share underperformed. As far as I know, we started building on this position plus minus 2 years ago. So we believe Woolworths food division is one of the few world-class businesses in South Africa, and the division continues to produce strong sales and profit growth at return on capital. So competitors like some of your Checkers and some of your other brands, Pick n Pay, Elite brands, have clearly noticed the success and are definitely targeting Woolworths high-income customers. But in our view, the brand has a large equity with its clients, and the competitive moat around the business is very strong. So the fashion business, you'll see here at the bottom, fashion, home, beauty division has had a much tougher time over the last few years, and we think profits are well below potential. It's not a certainty that the division can be turned around in a competitive market, but given the upside, this is definitely a major focus of Woolworths management. And then you've also got Country Road. I mean, there's lots of learning there from Australia, where they have actually encountered a lot of online shopping. So we also see some upside there. And then lastly, David Jones there at the top. You can see the earnings for David Jones is a lot lower compared to this food earnings. So EBIT, it basically stands for earnings before interest and taxes. So this is just a way to compare the earnings of the different divisions. So David Jones remains a risk and an opportunity as the department store model comes under pressure globally, because we know a lot of businesses are moving online now. But Woolworths, they're definitely aware of it, and they are reducing some of their stores. And they've also sold a few property portfolios, or a few in their portfolio, to also start paying down debt. So maybe just to summarize it, we say that the price you pay is the most important determinant of your risk and the future return that you can expect from the share. So right now, Woolworths is trading at around 10 times our estimate of normal earnings. So you can actually see earnings here is 4 billion. And if we take it to the market cap, it's also plus minus close to 40 billion market cap. So you're paying 10 times for earnings right now, which we think is very attractive. So we've been looking for companies in South Africa specifically that can increase the value of their business independently of the economy. I mean, the food business continues to grow despite what's happening in our South African economy. Okay, and then just 2 last slides. So just moving on our foreign portion. As I mentioned earlier, about 30% of the fund would be the offshore portion where we invest directly with Orbis. But I mean, if you look at it holistically, it's actually closer to 2/3. The foreign portion of our balance fund looks quite different to many of our peers. And the 2 big differences are we've been underweight the US market for the last few years. And within that 30% invested amount, we haven't been fully invested in shares. So we have a bit in cash, and then a little bit in hedged equities, which is almost like an insurance on equities. But both those things have actually hurt us over the last few years, because the US market has done really well. And what I've shown on this slide is just in gray, you've got the S&P 500, and in red, the world index, excluding the US. So we know that the world index has been quite strong, but it's interesting when you strip out the US, which is about 60% of the world market, how different those two actually look. So the US again has had this huge bull market over the last decade, when actually the rest of the world, if you think about Japan, Europe, and some emerging markets, haven't been that great. So being underweight the US has hurt us, and they not being fully invested in shares has also hurt us. So what are we doing right now? Are we changing that? Actually, we're not. It still looks pretty similar. And in fact, we're probably doubling down on those bets. So we're actually even more underweight the US than we have been. And this next slide, my last slide, explains that. So just drilling into, that previous chart a little bit more, we know the US has outperformed the world index, but it's actually interesting if you just look at the subset within the US that have done really well. So we all know technology stocks have really been the leaders. So what I've done here is I've stripped out the technology stocks. So the acronym we use here is FAM, which basically stands for Facebook, Apple, Amazon, Alphabet, Netflix, and Microsoft, your big technology stocks. So those stocks have done phenomenally well, and those are big stocks in the index. Over the past 6 years, they've went up like 4 times as a group. And the line here is the S&P 500, excluding these big stocks. And the US market has done well, but phenomenally well. So really, it's been actually the tech stocks that have been driving the US market. And then way at the bottom, we've got the light gray, which is the rest of the world index. So as I mentioned, we are underweight the US. We are worried about valuations, which we think are very high at the moment. It's definitely hard to call, the market top, where that's going to be. And we're not trying to time the market at any means. We don't have a low weight in the US because of this chart, but we look across the world where we can find the most attractive opportunities from the bottom-up basis, and that's where we invest. So we definitely think it's the right call to have a lower weight in the US right now, although it's hard to know when things will start to change. That's it from my side.
Cool, thanks a lot, Marise. So 1 or 2 things on that, the Allan Gray Balanced Fund features in quite a few client portfolios. So I appreciate the information that you brought there. And I think two things that stand out for me is firstly, price is obviously super important, and as we all talk about, it's all about what you pay for the asset. And I note that you guys said you actually use quite a lot of your cash to do two things. And one of the things was to actually load up on shares, so to buy equities or shares as the pandemic hit South Africa in March and April. And those were two of the months, or in particular the end of March, beginning of April, where everything happened in the market, or every stock in the market dropped. There was a big market correction. So would that mean that you got the equities or the shares that you bought in that time, you got for quite attractive valuation? Or talk me through that.
Yes, that's correct. So, I mean, even using the financial stocks as an example, we saw prices that we haven't seen in a very long time, going back to the 80s even. So definitely we saw a lot of attractive opportunities. And as a asset management house, I mean, we definitely take a long-term view when we buy some of these shares. So it's not as if we think everything will recover and correct within a year. I mean, some of the financial stocks, their earnings have been hurt, but we definitely think the price that we paid has incorporated all of that risk. And we know that in the next 2, 3, 4 years, we're definitely going to reap the benefits of that. So yes, we have definitely increased. That's why I said our equity holding is, I mean, at a record level. It's sitting at 60% right now. It's very high. So even
almost
with
at
bonds,
capacity.
Yeah. So even with bonds, we've seen a lot of value there as well. I mean, even inflation linkers in our stable fund, for instance, we were able to lock in a return of 4-6% above inflation. I mean, that's kind of unheard of. So we definitely saw a lot of value back then. And yeah, we were able to make those changes as we needed to. And I know some of our competitors maybe de-risk their portfolio a little bit. But when we compare the different asset classes from the bottom up, we first look at cash and we ask ourselves, what is the total return going to be from cash over the next 4 years? And we know rates have been halved, interest rates. So cash is not, as great an investment as it has been because interest rates has come down a lot. So then we look at the other asset classes. We then compare it with equities, with bonds, and equities for us is the number one asset class right now where we see a lot of value.
Yeah, that was going to be my second point. That's what I've been saying to a few people, is that because of central banks around the world trying to stimulate the economy or the world economy in the pandemic, everybody's been reducing rates. Everybody around the world, in particular the United States Federal Reserve, South Africa, our repo rate has reduced a lot. So you can't hide in cash anymore. Going forward, cash isn't giving you returns. And on the flip side, because of the trouble South Africa is in from a debt point of view and other markets in the world, we are more risky, which means our bond interest rates on our bonds are higher. So that's quite interesting, that you move some of that cash where you aren't going to be getting a lot of return going forward because of the low interest rates around the world, including South Africa, into bonds where you actually are getting a lot of, or a good bond yield, because we are more risky. So this is the one. So bond investors are happy that we have a lot of debt in a way, because you're getting these high bond yields. Okay, cool. The other thing that I am hearing a lot about and that basically came from your presentation was A Tale of Two Decades, which is, a play on words from Charles Dickens' novel, A Tale of Two Cities. So we know that in the first 10 years of from 2000 to 2009 or so, we had a great time in South Africa in the JSE, and then the last 10 years have been offshore, and particularly the US and the tech stocks. And the questions that we have, but are very difficult to answer, are some of the things that you mentioned. Is when is the market correction? Because US stocks are trading at very high multiples. does South Africa have too many headwinds to actually become the next, the tail of the next decade?
Yes.
And so in that context, we've got Joe Biden as the new president of the United States, and then also we have the Democrats winning over the House, and more importantly, winning over the Senate. So what does that power shift mean for South Africans or South African investors? Because we know that when America sneezes, the whole world gets a cold. So how is that
Exactly.
going to affect us? If you
Yeah.
talk about that a little bit, please.
So the US fiscal and monetary policy has a profound, consequences elsewhere. So large scale money printing could promote capital flight out of the dollar into other currencies, including, those of emerging markets, and we are definitely one of the beneficiaries. So the South African economy is quite open and it's leveraged to the external sector. So if the global economy improves, we also improve, since we are an open economy. And, we are also influenced by what's happening globally. If there's high inflation levels, then that will also roll over to South Africa. So we are actually moving closer to a global inflation norm. In the past, that wasn't always the case because we had quite a lot of growth in wages, specifically public wages as well. So that has pushed up our inflation number quite a bit. But our economist Sandy also believes that we are moving closer to a global inflation norm. So,
So what is a
yeah.
global inflation norm? What does that mean?
Yeah, so right now we are at the lower band of, say, close to 3%. The target band is between 3 to 6%. But in some countries, the inflation is close to zero. If you look at Japan, some European countries, etc. So we might expect a lower inflation going forward to be more in line with some of the global developed countries. But the one thing that I do need to mention is that someone will have to pay the bill at the end of the day when you look at the US, who's just continuing to print more and more money. And with Biden, he specifically wants to aggressively print more money. And that will definitely, support the economy, and there will be a lot more money moving around. People will be spending more, which will, all of that will boost the economy. But you will have to, the party will come to an end at some stage, and you might see inflation ticking up. And as that inflation starts to increase, that will then also flow over to South Africa as well, where we see a potential higher inflation number in the future.
Okay, thanks a lot, Marise. That's great. We've gotten the very important but quite weighty market and performance view over and done with, or that part of the presentation. So thanks a lot, Marise. Next, we're going to one of my sort of personal favorite topics, one of behavioral finance and how that affects our portfolios, because often high finance is sometimes very complicated, and EBITs and inflation norms and all that sort of thing, we sort of leave that for the investment managers. But stuff that we can internalize and do our part in is the way we approach investments or our investment behavior. And for that, I'm going to hand over to Taryn Duncan, my business development manager from Allan Gray, and she's got a great presentation on this. Taryn, over to you.
Cool. Thanks so much, James. I'm just going to share my screen. And if somebody can give me a thumbs up, let me know that you can see that.
Yeah, it's on.
Fantastic. Thanks so much. Okay, so firstly, I'd like to say thank you so much to each of you who've joined us today. I think from Marise and I, we really appreciate the opportunity to speak to the end investors who use our funds and our platform, or both, to save towards your financial goals. I've been in the financial services industry for just over 5 years. Over 8 years now. And over the course of my career, I think I've learned, as James was saying, that investing is not just the study of finance, it's the study of human behavior. And so I'd like to spend the next kind of 15 minutes or so giving you some examples of how this is true, and maybe some tips on what you can do to improve your chances of having a successful investment outcome. So I'm going to spend my time in 3 areas. Firstly, I'm going to explain what I think the key components of a successful investment are, then looking at the drivers of that explain certain client behavior, and then lastly, what action you can take to increase your chances of success. So if we look at the components of a successful investment first, I'm sure that we could find more, but today I'm just going to focus on 5. So something I'm sure you've heard from James is that it is of utmost importance to start with a plan. When I worked as a financial advisor, I always remember my boss saying that we plan in order that we can be flexible. When you have a plan, you can change direction and still be in control, but without a plan, you're sort of a bit like a headless chicken, I suppose. So this plan would typically look different over different time horizons or for different goals that you have to achieve. So from an emergency fund in the short term to maybe paying school fees in the medium term, all the way over to retiring comfortably one day, which is sadly something that very few South Africans are able to achieve successfully because they didn't plan well enough. So the first thing is to start with a good plan. The second component for success is to start saving as soon as you can. I'm sure all of you have heard of this concept of compound interest, which is the investor's best friend. And the longer the time horizon of your investment, the longer your money has to compound. So I think this is a good example. This is a graphical picture of a person who's saving for retirement. She starts off with a salary of 20,000 Rand, and that escalates with inflation each year. And she contributes 15% of her salary to a retirement fund. So as you can see, in the first 10 years, nothing really drastic happens to the investment. But after the first 10 years, the trajectory of her return gets much steeper. And this is the power of compound interest at play. So if you think about it, it's probably quite hard to save for those first 10 years. There are a lot of competing demands, like maybe the kids and the house and the car. And so you might look at the graph and think, oh, well, I can afford to kind of wait 10 years before I start saving. But the fact is that you don't miss out on, the gray line would then be if you started saving later. The problem is that you don't miss out on the first 10 years by delaying your savings for those 10 years. You actually miss out on the last 10 years of growth. And that almost cuts your balance at the end in half. So by waiting, you're actually robbing yourself of compounding that you can never replace. And so the second point is to start as early as you can and let compounding do the work for you. And the next thing is to earn real returns. Now, what I mean by that is returns that preserve the value of your money against inflation. I'm sure that many of you know that sort of what you could buy with 100 Rand 10 years ago is in no way similar to what you can buy with 100 Rand today. And in fact, I think we've seen inflation in overdrive when you look at the price of certain foods during lockdown. I remember the price of a block of butter was something like 55 Rand about this time last year, and now it's well over 70 Rand. So to illustrate the importance of real returns, let's say that your goal for retirement is to have 17 times your last annual salary. That's represented by this red block at the bottom here. Some research has shown that this is kind of the target that you should aim for, 17 times your last annual salary. Now, if you take your contributions and you put them under a mattress, you'll never get close. Just 2 times your last annual salary. If you put your money into something like a money market, you'll basically keep up with inflation and have just over 6 times your last annual salary. And of course, this research is slightly older. Marise and James have just discussed the fact that a lot of interest rates have come down as a result of the crisis that we've seen over the last 12 months. But then lastly, if you invest the same contributions into something like a balanced fund, you'll get the remaining 11 times that you need, made up of real returns and compound interest. So you need real returns in order to achieve your goals and have a successful outcome. But of course, important to remember they don't come in a straight line. More on that later. Next up is diversification. I think this is probably one of the most commonly known investment principles. And so simply put, it would just be don't put all your eggs in one basket. Diversification is ensuring that you've got exposure to different asset classes, currencies, economies, and shares. And sometimes the market is the best place to be invested, but other times cash and bonds give you a better return. And so you saw in Marise's presentation that 10 years ago, the South African All-Share Index outperformed global markets, but then the offshore markets have outperformed over the following 10 years. So investing in a diversified portfolio means you have a bit of everything. And your portfolio manager has flexibility to move between these different assets in order to maximize your returns when they see opportunities to do so. And so the graph on the screen is actually a representation of all of the individual positions in our balanced fund. So you can see that even without including other funds in your portfolio, you can already achieve diversification in something like a balanced fund. But on that point, what diversification is not is trying to split your money between 10 asset managers or 15 different funds. There's definitely a benefit to mixing different fund managers. You get diversification of ideas and styles and philosophies. But of course, I think you should speak to James to figure out what the best options are for your particular set of goals. Okay, and then the last component to our successful investment outcome is this idea of trying to switch and time the markets. Now, sadly, the vast majority of times people get this wrong. So in an ideal world, your goal with timing the market would be to invest aggressively when the markets are cheap. So when you're down here, so that means that you'll enjoy the full ride up to the top. And then in a perfect world, when you get to the top, you'll switch to cash and you won't participate in the downturn that the market experiences. And then once you hit the bottom, back into the market so that you can enjoy the next ride up again. Now, sadly, this is almost never the case. And we see that when markets go up, investors get greedy and they buy into the market. And then when they hit rock bottom, investors fear that they'll never recover. And so they sell out of the market, which is, of course, exactly the opposite of the ideal. I don't think anything illustrates this better for me than a real example. So this is an actual investor that we saw on the platform. It's a little bit out of date, but I think still very relevant. So this was a 70-year-old male who invested in a living annuity. He had 458,000 Rand, and he invested it in the following split. So 40% into equities, 30% into the balanced fund, and 30% into stable. So you could think of that as sort of aggressive, moderate, conservative. So let's see how he fared. So at the start of his investment, we saw he invested, as I said on the previous slide, into equity, balanced, and stable. Now the red line represents the market performance. So when it's going up, when the red line is upward sloping, that means the market's doing well, right? The all share. You see the market does well. And so not very long after he's invested, he decides, no, well, the stable fund isn't doing nearly as well as the balanced and equity. I'm going to take what's in the stable and redistribute it into the balanced and equity fund. We keep going, and you'll see later on, obviously the equity market has continued to perform well, even though there's been a small correction here. So the investor said, oh, no, I'm going to put all of my money into equity. Clearly, you can see that it's the best place to be invested. That's the fund that's doing the best. Then, of course, there was a correction, which we saw. There was a small correction before the crash in 2008, and he got a bit scared. And so he said, no, I don't want to lose any of this money that I've made. I'm going to put everything into money market. But then it continued to go up. And so at the top of the cycle, which, he couldn't have timed it worse, he put 60% or 61% of his money back into equities, with the rest of it being in money market. And of course, we all remember, or most of us maybe on the call remember, what happened in 2008. There was a very large market correction, and about 3/4 of the way down, which is far too late already, he switches 100% of his money into money market. So at this point in time, he's locked in the loss that he's had on this entire downward cycle. And so the next action is probably not the worst one that he takes, which is he sees that the market starts to recover, and so he moves some money into balanced and equity again. And then a little bit further along, it's continued to recover and it's doing quite well. We're back up at similar levels to 2007. And so he puts more of the money into equity than balanced. And then at the end here, I think quite an interesting move. There must have been something very popular about offshore investing, maybe in the press, in the news, and so he's put 45% into an offshore feeder fund. The problem with this, so not all of the moves that he's made, like probably these three aren't the worst, but the problem with this is by interfering and switching and trying to time the market, he's actually destroyed his returns, because his portfolio value at the end of the day is 437,009 Rand. But if he just stuck with his original allocation at the very beginning, he would have had almost 15% more in money. So as a reminder, the 5 important steps in your recipe for success is to have a plan, start as soon as you can, get something that's going to give you real returns, that's well diversified, and then try not to switch and time the market. And I think that last point is really important, because research has shown us that this is largely driven by you as the investor. James, you have a question.
Yes, Dan, or more a statement. But I think that in point number 5, we very often want to do something, and we want to make a change. And sometimes it's warranted, yes. Sometimes we do need to switch, we do need to make a change. But sometimes doing nothing is doing something. So I like to just reiterate that. I think it's very important to switch sometimes, but when one doesn't switch, it's not necessarily because we're not doing the work. Sometimes not switching is the right move. Sometimes there's work that goes into, okay, we stay the course, we don't switch yet, in managing that fear and greed. So yeah, I just wanted to say that sometimes doing nothing is doing something.
I think that's definitely true, and it's a point that I'll absolutely reiterate at another stage in the presentation. And I think something on that is that we live in a world we've got so much access to data, but a lot of that data is just kind of raw, and it's not processed into useful information that sort of takes into account our individual circumstances. But what it does do is it plays on our emotions, and it makes us want to do those sorts of switching. And so that's actually what I'm going to speak about in the next section, which is about what drives our behavior. So I'm sure that more than one of you, no problem, James. I'm sure that more than one of you saw this example that I've just given of this real investor who's done some switching, and you're thinking to yourselves, that may be a real life example, but I would never do that kind of thing, and make those kinds of mistakes on my investment. So I'm actually going to put you to the test, and I'll be sending the results to James. If you could take a look at this illustration and tell me which line you think is longer. I'm going to put up a poll, so for now have a look at the lines, and you tell me which one you think is longer. Try not to cheat and put your rulers up against your screens. But let me just quickly launch this poll.
Are there only two options, Karen?
There are three options. You'll see them on your screen.
Okay, all right. I'm not allowed to vote, eh?
I think I did allow you to vote, but we'll see how it goes. Let's see what your clients think, because I think you probably know the answer.
Okay, well, I'm not allowed to vote. I've tried. I went with option A, but I'm not allowed to vote for it.
Okay, we've got about 75% of you have voted. And I see you've got a very clever bunch of clients, James, because if we have a look, you'll see that all of you have correctly said that both lines are the same length. But I think if we're honest with ourselves, we'd probably say that that's not necessarily what you thought straight away. So when you look at the lines, I think most of us would think that the bottom line is longer. And so for those who were thinking that, I think this is a great example of how our minds can fall victim to an optical illusion. Studies have been done with this exact example, and because you're also clever, you've beaten it. But most researchers show that people say that the second line is longer. So the visual perception part of your mind is tricked into seeing that something doesn't exist. So in this case, it's because of these little fins that are on the side of the line. So the right answer is that they are the same length. But the remarkable thing about this and other optical illusions like this is that even when you know the truth that the lines are the same length, you still see one as being longer than the other. So the insight that I'd like to give you is that we as humans are sometimes susceptible to cognitive illusions as we are to optical illusions. So these illusions are what we call biases, and they result from the use of mental shortcuts. And so we're going to chat a little bit more about that now. I'd like to do another poll. So I'd like you to tell me how you rate yourself as a motor vehicle driver. Don't think about it too much. Just give the answer that you think honestly describes you as a driver. I'm always quite surprised when I see the answers of some of my colleagues when we do these exercises. But let's have a look and see. We're getting some nice mixed results. 9 of you have voted thus far. And I'm going to end it off here. Okay, so let's take a look at the results. One person, nice and honest, telling us that they think they're a poor driver. 2 people saying they're above average. Typically, men think that they're above average drivers. I'm not sure if I'm getting that right with you. And then most of you have kind of categorized yourselves as average drivers. So I'll be very honest and say that when I answered this question for the first time, I also said that I think I'm an above average driver. And so interestingly, a recent survey in the US found out that 93% of Americans believe that they're above average drivers. And we refer to this as an overconfidence bias, because 93% of people can't be above average. It obviously defies the definition of the word average. And so interestingly, the overconfidence bias is actually quite a natural human state. All of us believe good things about ourselves and our skills. A book that I read a while ago had a quote that said, "Most of us believe we are better performers, more honest and intelligent, have a better future, have a happier marriage, are less vulnerable than the other person, but we can't all be better than average." So I think investors who suffer from an overconfidence bias tend to overestimate what they know and what they're capable of doing. And so how we see this play out in investing is that they believe that they know more about investing than the average investor, not only in terms of information, but also in respect of getting their timing right. And this bias can lead people to switch more often and fail to adequately diversify their portfolios as a result of this overconfidence. Okay, and then the last question for today. To offer a bet on a coin toss, how much would you want to win in order to make a possible 100 Rand loss acceptable to you? I'm going to put up the poll now. Okay, so we're going to toss a coin. You could lose 100 Rand. How much do you need in order to make a loss acceptable? How much do you need to win in order to make that loss acceptable?
I still can't vote, Darren. So I'm going to just say what my vote is. I'm going with A.
You're going with A. You need to double your money in order to be able to lose 100 Rand. So you want 200 Rand in return.
Yes.
Okay,
I want to make a profit here. I don't want to make any losses. Come on.
Good stuff. Good stuff. All right, we've got about 2/3 of you have voted. Let's see if anybody else just wants to put in a final vote. All right.
James, I don't think you should influence the voters.
All right.
Marise,
let's take a look at the results.
Okay. Whoever didn't vote A is wrong, right, Darren? That's
so the correct answer is actually 100 Rand.
Okay.
So you can see that most people here have answered 200 Rand. I think, James, you've influenced them. Some people, 4 out of 10 people, actually wanted 500 Rand. So you need 5 times more money to win to be prepared to lose 100 Rand. And then 2 of you said 100 Rand. So interestingly, the answer is 100 Rand. But the problem is, and what this illustrates, is that we experience pain from loss far more than we experience pleasure from gain. And so we call this the loss aversion bias. So for some of us, the market crash. Yes,
I just want to stop you quickly. Marise, I'd like to have your answer too, please. So
I'm going to say 100 Rand because she's done this before, James.
100 Rand.
Okay, all right. No, I'll accept that. That's fine. Okay. Sorry, please carry on.
Oh my gosh. Okay, cool. So this concept of a loss aversion bias. So I think for some of us, the market crash last year might have been the first time that we experienced a major drop in the stock market. And the pain that you feel from seeing your investment drop by 20 to 30% is something that doesn't go away quickly. And the reason that pain lingers is largely as a result of actually how our brains work. And so scientists have done a lot of research around this, and they've discovered that our brains react to the emotional pain of financial loss in the same way that it reacts to physical pain. So it actually stores a memory of the pain to protect us from future harm. And so that explains why investors want to sell or switch their investments to avoid future pain when their investment value decreases in the short term. Another reason why we're also so affected by this idea of losing money is that we place a higher value on something that we own rather than this value on the same thing if we didn't own it. So if that thing is your investment and some of it's taken away, even just temporarily, you experience a greater level of pain from the loss than the level of joy that you experience when your investment rises back up to where it started. And so we can't really remove this feeling of pain from loss, but it does help us understand which losses are sort of permanent versus temporary. So these are just a couple of examples, and I haven't touched on the recency bias, which Marise mentioned, but they show us that sometimes normal and even efficient thinking, when it's applied too quickly or inappropriately, can form a bias, and that influences our actions. And so what we see when investors take this kind of action is something called the behavior gap. So what is the behavior gap? Maybe we should start with what it's not. The global pandemic of COVID-19 has understandably caught some people off guard, and some of them have had to kind of dip into their savings. That's not what we're talking about when we refer to the behavior gap. So the behavioral gap is caused when investors move in and out of funds in pursuit of better returns. So for example, a major drop in the markets like we saw last year, many investors moved out of balanced and equity funds into money market because they were pursuing safety. Some of those investors are still sort of sticking with money market until they feel certain about how things are going. Others have maybe switched back because they've seen the market quickly recover and they're anxious about missing out on the rising markets. But this behavior is really common, and worldwide statistics have confirmed this. And typically it results in an investor earning a lower return than what they would have had they stayed in their original fund. And so I quite like this little sketch that's by a guy called Carl Richards, who shows that your investment return is higher than your investor return. And the difference between these two is as a result of your behavior. And these are kind of classic behavioral mistakes that we see people making over and over again. But I think what many investors aren't aware of is this the concept of the concentration of best and worst trading days in the market. For example, this graph shows the best and worst trading days for our balance fund. And this is up until the end of March last year. The graph shows the top and bottom 50 trading days bucketed into groups of 10. So it's the best and the worst. And the length of the line indicates the magnitude of the daily performance movement. So you can see obviously here 2008, some of the biggest, just the crash that we experienced, again here in COVID-19 crash. But around the same time, you can actually see that there are some really high performing days as well. And so you can see that they tend to concentrate around each other, suggesting that you run the risk of missing a recovery if you disinvest at the wrong time. And I think that's definitely true of what we saw last year. And so to maybe illustrate the impact of this, it can have a real and very significant impact on your returns. So this graph shows the impact of an investor who's missed the best 10 days, 20 days, and 30 trading days in our balance fund since inception. So that's about a 20-year period. Obviously, it's showing a bit of a worst case scenario because I think very few people on the call have been invested in the balance fund since it started. But if you look at the second bar here, it shows you that those investors who missed just the best 10 days would be at least 25% worse off than the investor who just remained invested. And that same investor would have experienced some of the worst trading days too, as we saw how closely concentrated they can be. So as I said, these are just a few examples of the biases that we see in investor behavior, but I think they make the point that our actions have a material impact on the success of our investments. And so we need to be made aware of these biases. We need to sift through the noise and the emotion, and we need to stick to the plan. And this brings me to my final point. This type of presentation can seem quite overwhelming and make you feel like you can't trust yourself to make good investment decisions. And that's definitely not the intention. I think the main point that I want to leave you with is that investing is, as James said, often about inaction rather than taking action. So provided you have a good plan in place at the start and you're positioned in funds that give you real returns and are well diversified, the main thing that you need to focus on is mitigating the damage caused by your own behavior. And the best person positioned to help you do this is your financial advisor. I'm not just saying that because I like James and I work with him, but Allan Gray is actually a very strong supporter of independent financial advisors, and particularly those that spend time coaching their clients to assist avoiding some of the traps that we've seen today. So the final thought that I'd like to leave you with is that working with your financial advisor is kind of like riding a tandem bicycle. And you can see here, this is a very well-branded Villic Wealth tandem bicycle. Your financial advisor is in the front seat and they're steering the direction, but you're still required to pedal hard and put in the effort so that you can work together to get to the destination of your financial goals. And so my encouragement to you is to trust his advice and know that sometimes when he's telling you not to act, it's because he can see one of these biases creeping into your actions. And that's it from me today. So thank you for your time, and I wish you all well going forward.
Thank you very much, Darren. I don't know where you got a picture of the Villic V2 motorbike.
I know.
But yeah, on the other side, there's a little bit of a motor. So as soon as you start pedaling, you get an extra speed, and that's
like a boost.
Yeah, and that speed is called diversification of assets. So no, that wasn't such a great joke, but I hope some people are laughing. Thank you. Okay. Anyway, so we've sort of run out of time, so I'm going to conclude relatively quickly. But what I wanted to say is that there's obviously some concerns as a South African. We've got mounting debt with unemployment, and then because of the way we've seen government handle certain things that haven't maybe left a good taste in our mouth, what is the effect, or how efficiently will the government roll out vaccines into the country? What are the implications of it if they mess it up? What is the implication in terms of how many more people will get COVID and so on? What will the impact be of another lockdown? So there are all these real risks. But from an investor point of view, I think that the economy has a much lower correlation to our investments than we may think. And that if we look back over the last year, despite COVID-19, investment portfolios have shown some growth. In a period where the economy struggled significantly, markets dropped, but they rebounded. And in times like in times of uncertainty and disruption, like now, there will always be investment opportunities. You just have to find them. And I think robust investment processes and plans and good stock picks are really important. So I've been thinking a lot about what my job is and what my job isn't. And my job is not getting the highest possible returns. My job is providing good, comprehensive financial advice. My job is not getting the best returns. My job is building and managing a sustainable portfolio that will last and look after someone over the long term. So what do we do in times like this? What is our job? What is my job? It's focusing on things that we can control. So we can control the amount of diversification in a portfolio. We can control the investment process and philosophy that we choose to follow in the investments. We can control the amount of risk that we take. So are we taking enough risk but not too much risk? Do we have a risk appropriate portfolio? And then, like Taryn was mentioning, guys, we can be cognizant of our emotions and the bad habits that could cause us to make bad investment decisions. And you see, in a COVID world, fear and greed rule, and we can't let fear and greed rule us. So a measured approach is what is applicable now. And yeah, I'm pretty optimistic. I think the portfolios have done well over the last year. We've participated in some of that rebound. And I think that it's not all doom and gloom going forward. We can have exposure to shares that aren't focused in South Africa. We also have options to go offshore, and we've got great bond yields. So it's not all doom and gloom. And I think we need to focus on what our jobs are and what we can control. So on that note, I just want to thank everybody for joining us on the webinar today. I know your time is valuable, so I really appreciate you sharing some of your time with me and with us. Marise, Taryn, thank you very much for being presenters and sharing with us. I think it was really, it was very beneficial. The high finance stuff, Marise, thank you very much. Delivered it really well. And softer stuff, Taryn, I appreciate it. So with that, I think, we're going to close and we're going to end the meeting. But thank you, everybody, for sharing your valuable time with us and with me. And if you do have any questions, please email them to me and I'll get Taryn and Marise to answer them, and we'll pass on the answers to you. But thank you for attending and have a really great year. Goodbye.
Thank you, everyone.
Thanks so much. Thanks, James, as well, for including us.
Thanks. Okay, bye.